What's up traders, Tom here with another video. Today we'll be discussing Warren Buffett's old investing trick, how to recognize value in the stock market versus an overvalued stock market. Some would say he's the best to ever do it. So what is his old trick telling us now? Stay tuned. In this video, we'll be discussing the Warren Buffett indicator, how we can actually properly apply it to current markets, and whether it even works anymore. I think everyone will find this video pretty interesting indeed. Just a reminder to make sure you subscribe, hit the like button to support the channel, and comment down below to give me ideas on things the trading community wants to see us cover next on this channel. Also, please make sure to check out our trading Discord community down below in the links. It's getting bigger and better every single day thanks to you. So let's summarize what is the Warren Buffett indicator and how does it work? Well, firstly, the Warren Buffett indicator, to put simply, is the stock market capitalization of all US stocks relative to the nation's gross domestic product. What this means is that when the stock market is trading overall below the gross domestic product, it's a buy signal. And on the other hand, when the stocks are collectively trading above the GDP, it indicates a sell signal. Here we have a few different overvalued and undervalued levels. So traditionally, it's been that if the market is under 50, between 50 and 75, it has been undervalued or significantly undervalued. When the stock market has been between 75 to 90, it's been fair valued. And then when it's been above 90 and anything above that, it's been significantly overvalued. So let's take a look at how Warren Buffett used this in the past to make his great fortune, and also whether it's still going to work today. So I think we'll start with this chart. And this chart is the GDP of America over what's called the Wiltshire total market. We'll talk about what the Wiltshire is in a minute, just so everybody knows. But basically, you can see here that over time, the market was actually significantly undervalued by this metric all the way through the 1980s, 1990s, all the way to the tech boom. Then there was the tech bust. Then there was obviously the GFC bust. And then since that point, we have reached kind of a new paradigm. And we'll talk about this paradigm and we'll talk about why things are different and where the new levels, I believe, are on the Warren Buffett indicator for the current market moving forward. So just quickly with the Wiltshire index. So the Wiltshire 5000 total market index, or more simply Wiltshire 5000, is the market capitalization weighted index of the market value of all US stocks actively traded in the United States. So as of December 31st, 2019, the index contained only 3,473 components. So it's very important to understand what it is, because then it gives you a bit of an idea of how to contextually apply it to the markets. So here is an indicator in terms of the Buffett indicator versus the Wiltshire over time. As we can see, it has gone drastically between 34.6% all the way up to 136.9% and is now currently on all-time highs when compared to the Wiltshire. Does this matter? Well, of course, history would tell you that markets are returning, but things have changed, which I'm sure many people are aware of. You can also see how good the opportunities were during the tech bust and during the GFC bust when you're considering this particular indicator. In history, you would think, wow, what a great time for you to be buying the markets. And it certainly was. And of course, you would have done incredibly well over the last couple of decades if you were buying at under 100% on this index. So if things were that easy, everyone could make money, yes? And of course, right now, Warren Buffett's favorite stock market indicator is hitting record highs, signaling a potential crash could be coming again. But here's the problem. When we're looking at the Warren Buffett indicator, and here's the chart versus the S&P 500, we can see the danger zone, which was historically considered around 80. And then we can see the extreme danger zone, which was about 120. And we are now trading at around 125 according to this particular indicator against the S&P 500. So should we be concerned, or should we be rethinking what the Warren Buffett indicator actually means? So to put how successful Warren Buffett has been, many people are aware that if you invested $10,000 in Berkshire Hathaway at the end of 1964, you'd have around $200 million as of May 18th, 2020. Of course, that is an amazing return and the numbers cannot be denied. But here's where I think things start to get a little bit different. And that's when you compare Warren Buffett's current portfolio earnings over the last couple of decades when you compare them back to his 70s, 80s, and even 90s returns. So here is Berkshire Hathaway versus the S&P 500 over those periods of time. The reason I bring this up is because when you're looking at all of his outperformance, look at how his outperformance was so extreme during the 70s, into 80s, into 90s. And then since that point, he had some pretty good outperformance all the way up to the GFC. After that point, performance has lacked. And I believe a lot of it is because Warren Buffett uses this indicator actually as a tool for him to purchase overall. He really must use this indicator and firmly believe everything about it. But like everybody knows, everybody has their day in the sun when it comes to trading. Many traders might be absolute wizards for 20 years and then they fall off. And it seems like Warren Buffett's time is coming to an end in terms of being the best stock picker around. Because his performance not only has lacked, but he also hasn't taken advantage of key opportunities. And I think a lot of that is to do with his understanding or use of this current indicator. So let's go back to this chart and consider the danger zone at 80 and also consider where the market was before the dot-com bubble. Remember, when we looked at Warren Buffett's actual returns versus the S&P, he did significantly better all the way leading up to just before the dot-com bubble and also during the period after the dot-com bubble into the GFC and then not really after that. So the Warren Buffett indicator actually had very good value on it all the way through, other than the dot-com bubble, which if you see any of his old interviews, he literally said it was completely overvalued and he wasn't going to buy anything. And then he obviously did buy stock after that point, and he did buy some in the GFC. But we are now at a point where he has been selling in the market and he has been underperforming for the last 10 years. So when we're looking at his indicator, we are basically at a point where we are equal to the dot-com bubble in terms of value. By some metrics versus the Wiltshire, we're even higher. So we are extreme valuations and the market has surely changed because as we see, it is going up significantly over time. So why is this, and why does the indicator not work like it used to? Well, I think the first thing we can talk about is that we are looking at a totally different scenario from the world in terms of globalization. So here we have a chart where we basically are comparing the market capitalization of a country's market or stock market versus the actual GDP of the country. And this actual comes from Seeking Alpha. And basically it's saying that Switzerland was about 258% GDP. There's a lot of reasons why companies do list in Switzerland and they're on the stock market. But pretty much this means that listing on an exchange has nothing really to do with a country's GDP. And it kind of debunks some of what the Warren Buffett indicator is showing us. Let's take Nestle for an example. So everyone knows Nestle, and it has an incredibly high valuation here in terms of its weight in this particular index, almost 20%. But when we consider where the earnings for that company come from, obviously most of the earnings are from the United States and other countries. They are not from Switzerland, where the actual company is on the stock market. So if we compare a country's GDP to the stock market, we can't really do that in this world of globalization. We can do it to a degree, but when it worked for Buffett all those years ago, it was not as global as it is now. Most of those companies inside of the S&P 500 and the Dow were actually companies earning money in that country. So was he a genius? I think so. I totally believe he was ahead of his time with this idea. I think it's an amazing concept and it proved to be incredibly correct for many, many decades. But what about the current S&P? What's happening now? Well, we did a video on this and many people have talked about it. S&P 500 is now made up of over 20% of the entire index is now 5 large companies. What are those companies? Well, they are Microsoft, Apple, Amazon, Google, and Facebook. Tech companies that earn money everywhere in the world, and in fact, that earn money everywhere in the world. So when they're making money, they're not necessarily making it just because it's based on the GDP of America. And I think that's a great point to bring up, and one of the main reasons why the Buffett indicator needs to be re-looked at when you're assessing the stock market and valuations. Another one that I think comes up a lot is interest rates. When interest rates are low, equities have done well. Properties have done well. Things, generally speaking, anything that is a growth object does well during times of low interest rates. Now, if we look at interest rates over time here, we've got from the 1980s all the way to now, we can see pretty much what is happening, which is interest rates have steadily decreased. And even with the massive amount of economic growth that happened in the United States over the last decade, they were barely able to try to bring interest rates back up and have had to quickly cut them all the way back down again. Now, if you're a believer that interest rates are going back up to 6, 7, or even 10%, then of course you should absolutely not be buying equities because that would crush the current valuations of equities. But if you believe that we are now in a different kind of dimension with interest rates and interest rates are going to remain under 2% for the next foreseeable future, which definitely seems possible, then it seems that this has changed the way that we value stocks. So I'll bring up another point, and that is also changes to corporate taxes. During the last couple of decades, have corporate taxes remained the same? They certainly have not. Remember, if a company doesn't have to pay as much tax, it makes more money, which then allows it to have a higher valuation. So corporate tax changes all the way from the 1950s to the 1980s and then above that point have changed significantly. I believe taxes used to hover around 50% back between the 1950s and 1980s. And now they are much lower, 21% or less. So you have to change the way you think about things. Does the Warren Buffett indicator still show us value in the market? I think it does. But if we go back to this actual chart at the front here, just because it used to say 115 means significantly overvalued, I believe that number has completely changed. We're probably looking now more at something like a 130 or a 120 in terms of valuation. And that is just because corporate taxes, globalization, interest rates, and also the fact that money has changed forever since Powell's printing press has been introduced. So to summarize, there's nothing wrong with using this indicator, and it's still a great top-level approach when it comes to trading the market. Is it as good as it used to be? No. But Warren was certainly above and ahead of his time when he came up with this concept, and I think it was a stroke of genius, and sometimes the simplest concepts work. He's obviously been a great stock picker, but his overall way of looking at the market so simply worked for him, and it was amazing. Do we have to change the way everybody looks at the market since this crisis? I believe so. And if you've been enjoying our content, make sure to subscribe, hit the bell, like our videos and support us. And obviously we will be covering these concepts in more detail in the future. And we'll also be covering where fair value even is in these new market conditions. Thanks everybody and happy trading. Bye.